Hello and welcome to Forex.Academy, the #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing trading stocks and Forex versus trading cryptocurrencies. Many people are wondering if trading cryptocurrencies can match trading stocks or Forex in terms of profit potential. Many factors that affect traders' choice on which markets to trade. Whether it is the liquidity of the market, volatility, or simply the ease of access to the profit-making trade, everything and anything can influence that decision. We can certainly point out a few factors that differentiate stocks and Forex to cryptocurrency trading. Ease of access. When it comes to trading, the ability to start the process fast and without any issues should be a priority. When it comes to stocks and Forex trading, trading software is expensive and requires a lot of paperwork and time. It is also demanding in terms of computer performance. On the other hand, cryptocurrency exchanges and trading platforms offer quick and painless registration processes, as well as the ability to trade from the device in most cases. Stockbrokers also have a day trading rule which requires accounts to have more than $25,000 balance in order to day trade. This rule is called the Patent Day Trading Rule and is created by FINRA, the Financial Industry Regulatory Authority, to stop people from day trading stocks with no intention of supporting the companies or investing into the stocks for the longer term. This makes the barrier to enter the playing field when it comes to trading stocks much higher. Volatility. Volatility is the single most important indicator when deciding whether something is tradable or not. It signifies the price oscillation of the tradable asset. The more volatile the asset is, the more profit potential it has. It is safe to say that cryptocurrencies are far more volatile than stocks or Forex and still have enough volume for traders to avoid any form of slippage. Markets like Forex or the big stock indexes are safer but also much slower. We can compare the NYSE FANG index, which consists of the biggest tech companies such as Facebook, Amazon, Netflix, Google, Alibaba, Baidu, Nvidia, Tesla, and Twitter. This stock index has returned a total of 21.65% annualized total return, starting from September 19, 2014 until October 31, 2019. It has outperformed the Nasdaq 100 index and the S&P 500 index by a large margin. Still, when compared to the return Bitcoin has made from September 2014, it's not even close. Market liquidity and market depth. Bitcoin and the cryptocurrency market have a decent-sized market, but not close to anything like Forex. Forex is by far the biggest tradable market in the world. It trades $5.3 trillion each day. However, even though the cryptocurrency market is a lot smaller, it has no liquidity issues. Both markets are liquid and the market depth is good enough so that traders do not have to worry about their orders not being filled or any form of slippage. As far as liquidity goes, any market liquidity that does not allow for slippage and sudden non-fluid jumps in price are good enough for trading. Institutional involvement. Institutions are trading every form of asset and commodity they can earn money on. However, the cryptocurrency market is still young and fairly free of institutional manipulation. There is no denying that institutions manipulate the order books and use the latest software and best technology to create a trading edge. This can make trading assets extremely hard. Forex is especially filled with an algorithmic robot trading and market manipulation to a degree, which tends to hurt all profit potential traders should have. According to data gathered by Morton Glantz and Robert Kissel, the percentage of algorithmic trading in Forex is ranging from 85 to 90%. On the other hand, algorithmic trading in cryptocurrencies is minuscule compared to the numbers of Forex shows. Competing with machines which are analyzing as well as entering and exiting positions faster than any human can be extremely hard. Regulation. When compared to Forex and stock trading, cryptocurrency markets are less regulated. This gives many platforms a chance to rise and try to offer the best option for the traders, as it is much easier to create a cryptocurrency trading platform than a Forex brokerage firm. However, quantity does not mean quality. Only a few exchanges are offering innovative and good options to their customers. Many trading platforms offer crypto traders 100 times leverage on their trades, among other options, making it much easier to start with less money and profit from a small movement in price. Uptime. Quite simply, cryptocurrency is trading every minute, every hour, and every day. There is no downtime, not even for holidays. Forex markets, on the other hand, are not tradable on weekends, while stock markets have trading hours each day. Why should a trader lose 2 trading days a week in the case of Forex, or even more when it comes to stocks? Most retail traders are only trading part-time, and this gives them the option to be more involved in trading as the markets are available and tradable at all times. In conclusion, every trader needs to decide how much risk he or she can handle. Trading cryptocurrencies is a bit riskier, but brings massive profit potential. On the other hand, investing in stock indexes or Forex can bring constant minute profits over a longer period. If you enjoyed the video, please like and subscribe and comment down below if there's anything you'd like us to cover in future, or if you would like to discuss the topics we have covered. Have a great day.